Good afternoon, everyone. My name is Natalie, and I'm going to be your moderator this afternoon for today's free trading webinar with Option Hotline. Hopefully some of you were here for the website tour before we started with the webinar, but if not, do not worry. We will have another abbreviated tour at the end of the webinar as well, so please do stick around for that. We are here today to welcome Kerry Given, aka Dr. Duke. He is one of the commentators on Option Hotline, and he is going to be talking with you all about playing the earnings announcement. We have a lot of great information for him to cover. Dr. Duke is the founder of Parkwood Capital LLC, and he's been trading since about 1999. He is very well respected in the field and is a very intellectual trader, and I think you will, if you're new to him, come to see that during his presentation. He's got his BS from the University of Florida and his PhD from the University of Minnesota. So he is an actual doctor. We do have a doctor in the house today, which is fantastic. He is often invited to engage at speaking events, the Money Show, Traders Expo, the Board of Options Exchange, and several other reputable firms that he gives out education to people who want to learn and trade. And he's also authored several different books. So without further ado, I do want to introduce Duke. Are you with us?
I am.
Hi, welcome. We are so happy to have you here today.
Thank you, Natalie.
All right, so I'm going to go ahead. Duke, why don't you go ahead and take control of the screen? And
Okay.
while you're doing that, I want to remind everyone here, if you have questions during Duke's presentation, please feel free to type those questions in the chat box, and I'll get those over to him. At the end of his presentation, we've set some time aside to go ahead and answer questions from the audience. So please feel free to do that. Duke, I see the presentation. It looks good. So please take it away.
Great. Thank you, Natalie. And thank you, everyone, for joining us today. I promise to make it worth your while. What I'm going to be talking about today is a very speculative trade, namely trades that you might place in advance of an earnings announcement. And as we know as stockholders, earnings announcements can be scary things. It's like we've owned this stock for a while and everything's going fine. And all of a sudden, after an earnings announcement, some word was said or somebody speculated or whatever, and it takes a trade down. And it's disappointing because oftentimes it gets back up, but anyway, it can either spike up on us or spike down. So the first thing I want to emphasize that these kinds of trades are really what I call binary trades. It's like flipping a coin. You're either going to win or you're going to lose. There's no opportunity for adjustments. I like trades. Most of my trading are trades that I can adjust as we go, depending on the market moving. This one, you can't do that. So what I recommend is that you always scale these trades to control your risk. In other words, figure out what your maximum loss is and don't trade any more than that amount you can lose, that you can afford to lose. Given that, I'll say that I actually scale mine so that I'm not trading any more than about 5% of my trading capital. I'm not going to risk any more than that. Two fundamental perspectives. One is you followed this stock for a while, you know a lot about it, and you have a prediction. You have a good rational case for why you think it's going to go higher or lower or whatever. And so that's one perspective. The other perspective is maybe you don't know the stock that well, or even if you do, you're unsure because of some of the recent news. You're not quite sure where it's going to go. You've heard people talk about it in both directions with making good cases. So we have kind of the non-directional and the directional viewpoint. In any case, regardless of which direction you take, you've got some basic homework that you need to put in to have an idea of the ranges that are possible here. The first one is simply price a near-term at-the-money straddle. A straddle is where you buy a call and buy a put. You're straddling the fence. Now, if you look at that trade, it gives you a break-even range, and that's your price range. In other words, the low end of that is where some people are betting that this stock is going to go because they're buying puts down that low. And the upper end is the opposite prediction, the bullish prediction. So that gives you the range. In case you've ever wondered if you've been watching something like Fast Money on CNBC or any kind of program like that, and they're talking about Apple's earnings announcement, and somebody will say, oh, the market's pricing in a 5% move. And you think, well, who is the market? How do they do that? They're just pricing the straddle, because the straddle prices in effect represent the results of this auction. If you think of it, when people are buying and selling options, it's like an auction. The prices go up until you hit points, either on the low end or the high end, where people look at it and say, I don't think it's going this high. I'm not going to buy at this price. And so that's how you get that price, and that's why it means something. It's basically the market consensus for the high price that's possible and the low price that's possible. And a lot of academic studies have been done on this, and about 85% of the time, the actual move is within that range. The other thing to do is look at the past. Average of price moves after the past 3 or 4 earnings announcements. Get an idea of how much this stock moves. That gives you another price range. In other words, just average those moves. If it averages out to 5.3%, then that gives you a range of down 5.3 or up 5.3. The other thing I watch for is on the day of the announcement or a couple days before, is there anything unusual happening with the pricing in the market? You know, if you see a series of, especially on the day of the announcement, it's really trading up very strongly. Has to make you wonder, doesn't it? Does somebody know something? Are they expecting some great news? Maybe that's why you should play this thing bullishly. In any case, that's another possible piece of information. Now, if we have a prediction, we think it's going higher or going lower. Simplest thing you can do is buy a call if you're bullish, buy a put if you're bearish. The problem with that is that those options are very expensive because implied volatility has been bid up because of this earnings announcement. So you're going to pay a lot for each of those, either one that you buy. And then the problem is that after the earnings announcement, implied volatility collapses. So that means the price of that option collapses. So what that means in practice is that you have to have a big enough price move. Let's say that you're bullish, you buy the call. You have to have a large enough price move higher to make that call more expensive in spite of the fact that it's losing value due to implied volatility collapsing. So that makes that a tough trade. You can do a diagonal call spread that I'm going to talk about a little more. And that's where you go out in time and buy an option, usually in the money, and then you sell a near-term option that has all this implied volatility building up in it because of the announcement. So in effect, that allows you to lower the cost of that long-term call. And so that's the basis of a diagonal call spread. You're in effect buying that longer call because you're bullish, but you're selling an expensive front week call typically, and that lowers the cost of that long call, gives you an advantage. Or you might buy an out of the money butterfly. You could set up a butterfly up above the stock price if you were bullish, or down below if you were bearish. The advantage of the butterfly is they usually have a small or negative vega position. So the volatility collapse after the announcement doesn't affect that butterfly near as much as a lot of other trades. And you'll find that that typically is less expensive than buying that outright call or put. But what if you don't really want to play one direction or the other? You want to play the range, so to speak. You want to be able to say, I think it's going to stay within the range that the market's predicted, so I want to play that. Well, you can set up a double calendar. You have a calendar spread up above that's typically built with calls, calendar spread down below that's built with puts. That trade is primarily a trade that you would make a week or two before the announcement because it will appreciate as implied volatility rises. And then you would close it before the announcement because those calendar spreads will collapse in value when the implied volatility collapses. So that's a way to play the implied volatility change or increase without really playing after the effect of the announcement. Next, you might sell an iron condor. Iron condor has a negative vega. That means that it's not going to be hurt. It's actually going to be helped when the volatility collapses. So that's good. The critical problem with the iron condor is where do you place those spreads? You're going to sell a call spread up above the price. You're going to sell a put spread down below the price. Where do I place those? Where is it safe? Another possibility is to buy an at-the-money butterfly. Now these are small, like I said, small or negative vega positions, so the volatility crush doesn't bother you. The biggest problem with these is that they usually have a pretty small range of profitability. And as you push the wings farther out, that increases the range of profitability, but also increases the cost. And then possibly you might sell a straddle or a strangle. That's where you would sell a call at the money or sell a put at the money at the same time. Or you could move out of the money and sell the call that's slightly out of the money and then sell the put that's slightly out of the money. That's what we mean by a strangle. The problem with either one of those trades is that they have unlimited risk in either direction. Most likely you don't want to trade that, and most likely your broker won't let you trade it. I typically lean in one of two directions. When I look at the stock setup before the announcement, I very often will say, you know, it looks to me like this is going to trade either sideways or higher. And if that's my opinion, then I look at the diagonal call spread. I like that because it allows me to spend less capital or put less capital at risk than just buying a call. And you have a lot of upside potential, especially if you're used to just playing a typical vertical call spread. On the other hand, if I don't really have a good, strong opinion one way or the other, I'll just sell an iron condor. Now there, as I said before, where do I place the spreads? I typically look at the delta of my short options on each side. And I want it to be at least 12 to 15, something like that. Much lower than that, you end up with a credit that's just too small. It doesn't make a lot of sense. It's just not worth the risk. Because remember, when you're selling a spread, if you sell a spread and only gets, let's say you sell it for 5 cents. Let's say it's a $10 spread. That means that you have a profit potential of $5 and a loss potential of $995. Now, the fact that you're getting that small a credit means you have a very high probability. But it also means if this thing moves against you, you've got a big loss that's potentially there. It may not have very high probability of happening, but when it happens, it's going to hurt. So that's why I don't try and go too far out. Now, what about the diagonal call spread? How would I set that up? First of all, you want to sell the call that's in the expiration that's within the earnings announcement. In other words, if you had an earnings announcement tonight, you would want to sell this week's call that'll expire on Friday. Because all of the gambling, if you will, the speculating on this earnings announcement will occur in that option chain. So that's where the largest implied volatilities are. And that's what you want. You want to sell that real expensive option and buy your option out in the next expiration. Could be the next week, could be the next month, because you're trying to diminish or basically discount that long option as much as you can by selling this real expensive option. Now, one thing you don't want to look at when you set that up, first thing I look at is where is that lower break-even price? I want that to be close to or below recent support levels on the price chart, because you want to feel like your lower break-even on this diagonal spread is pretty safe. The other thing you want to be sure that you do, and this is an absolute requirement, don't trade this if you can't trade it for a debit that's less than the spread width. The reason for that is this: if you look at the risk-reward curve for this trade, if you're trading and spending more than the spread, let's say it's a $5 spread and you're thinking about putting it on for $600. If you look at the risk reward curve, it's going to have an upper break even as well as a lower break even. What that means is that you could have the situation happen where you're bullish, you put on this trade and it spikes higher and you end up with a loss because it spiked too far higher. So that's why I always position it with a debit that's less than a spread width. If I can't get that, I don't use that trade. Typically, I'm selling at the money and buying farther out. And the idea for that is when you sell at the money, you're basically selling the most expensive option. And that lowers that break even and gives you a smaller entry debit. What about the opposite? What if you don't really have a prediction and you're going to put on an iron condor? Well, how do you position those spreads? First thing I do, like I mentioned before, look at the break-evens of the straddle. That gives you two prices, gives you a lower price and an upper one. Then look at the average percentage move of the past, say, four announcements last year. Each one of those, you have a percentage move. You average those. Doesn't matter if they're positive or negative, just average those. And then see what price range that gives you. It'll average out to 5.5%. So then just price in from the current stock price, that much lower, that much higher. Another thing that I do is calculate 1 and 2 standard deviation moves. That's basically giving you the probabilities of these moves. And play that against these price ranges and decide, okay, where am I going to position these spreads that I have a pretty good probability on my side, and also based on the history, it seems like it's safe enough, and also based on the current straddle prices. Because remember, you could have a history that's pretty calm, but for some reason that straddle has a big price move, prediction built into it. Well, something's going on there. You need to pay attention. And then finally, what's the minimum credit that you're going to take? Like I mentioned before, if you move too far out of the money, it's safe, but it's just not much, it's not much profit. And you're taking a chance, even though it's a smaller probability of happening, you're taking a chance of a large loss. So that's why I typically stay at that point of about 12 to 15 delta for the short option. Okay, Natalie, I think you were going to have your announcement here.
Yes, thank you, Duke. We are going to do a quick pause for everyone, 30 seconds or less. I just want to, Duke's about to go into his second quarter of 2020, basically earning announcement trade results, and we definitely want to get to that, and Duke will have you go into detail about those. But before we do that, I do want to put up our special offer here. So I also would like to introduce someone from Market Education. Stephen, are you there? Do you want to come on and say hello and tell everyone what you're here for this afternoon?
Yeah, of course. Hi, Natalie, and hello, Dr. Duke. Good afternoon, everyone else. My name is Stephen, and my company, Market Education and Trading Commerce, in partnership with Option Hotline, works directly with Dr. Kerry Gibbon, or Dr. Duke, as we all know him, offering his premium trading services. It would be my pleasure to help you understand Dr. Duke's services and to assist you in signing up to receive his trade alert signals directly. If you have any questions about Dr. Duke or the trading services he provides, I would like to speak with you personally and privately. Please type your name and phone number in the private chat area, and I'll give you a call directly. By scheduling a meeting with me during this webinar, you'll qualify for a bonus offer that our company provides to any new Dr. Duke subscribers. I appreciate this time, and I hope to speak with you all soon. Don't forget, put your name and phone number in the private chat, and I'll give you a call. And now back to a man who is much smarter than I am. Dr. Duke, back to you.
Thank you, Stephen. Before we go right back to Duke, I want to draw everyone's attention to the screen in front of you. Duke is talking about trades that he does in his trading group program today. We're offering you a special coupon code for being an attendee of this webinar. The coupon code is 100FORYOU, 100FORYOU. Type that into the coupon area at the checkout on optionhotline.com for Duke's trading group and get an extra $100 off on his annual subscription. For those of you using a smartphone, you can put your camera right over this QR code and it'll take you directly to the spot on the website where you can enter that code. So we'll do a brief reminder at the end of the webinar, but just a brief pause to let you all know. Duke, we're going to go back to you now. Can you go ahead and take control of the screen again? And let's dive into those results.
Will do. Okay.
Okay, I see it. Perfect.
Thank you, Natalie. Like Natalie said, this is our results in the trades that we put on the earnings announcements in this last quarter's earnings cycle. We had 23 total trades. You can see each stock that we traded. as well as the type of trade. I only had one double calendar, and it was a relatively small return. But you see the condors and the diagonals. We had 18 wins and 5 losses. That's a 78% win-loss ratio. And that's important. That's important for 2 reasons. One, these are speculative trades, and you do have losses. I mean, and they're not trivial losses. Notice that Roku went against us, 91% loss. Sienna was worse yet. We lost it all. So remember, we may have a good winning ratio, but you have to be able to take those losses. So that means you don't, when you scale these trades, you don't scale them too large, because you don't want to have a hole that's just too big to fill up and climb out of again. If you'd put one contract in each of these trades, you would have a net gain of $1,543 at this point. So if you'd started with 2,000 bucks, it would have grown 77%. But just keep in mind, scale them appropriately. One of the most common mistakes I've seen in some of my students after they take an options coaching course is they go out, in spite of my advice, I always tell them, paper trade these things, get used to it, build your experience, and then just trade one contract. It may seem silly, you only made 150 bucks or you only lost 150 bucks, but that's the point. You gain experience without losing the farm, so to speak. Now let's look at a current example. I just put on this trade with the trading group this afternoon. Domino's is going to announce their earnings actually tomorrow morning before the market opens. It was trading at 430 bucks a share this afternoon. At 430 straddle, where we buy a call and buy a put, totaled about 25 bucks. So that gives us a range. Notice you just take 430 and subtract this, you get the lower end, add it and get the upper range. So this is the range that, in effect, think of, maybe some of you have been to auctions. Could be an art auction. I've been to some auctions in Southern Illinois where they're selling tractors and all sorts of stuff. And it's always interesting. Every auction is the same way. They seem to be kind of boring. And there's one guy that wants this thing and he's the only one bidding for it and so forth. Then suddenly they hit something and it's obvious that a lot of people want this and the prices just keep going higher. They're bidding back and forth and upping the bid and so forth. And it's exciting. Well, that's what happens basically in the option pit before an earnings announcement. There's all kinds of people buying puts and buying calls and so forth. And it pushes the prices higher. And so this range, it represents that bidding process. And so that's the best way to look at it. I'm explaining that because I think it's important to realize that there's a lot of people that are reasonably knowledgeable that are involved in that bidding process. And so that range is real. You need to pay attention to it. Now, I looked at the last 4 earnings announcement moves, price moves after the announcement, averaged 8.4%, pretty large. So that gives us a price range that's even wider than this one. Now that's sobering. Then I looked at the diagonal spread. What I did was I went long the option next week, 10/16, and sold this Friday's option. So I'm selling this Friday's 430, buying the 10/16 425 call. That worked out to be a debit of $465. The lower break even was 405, which actually looked very good on the chart. That was well below some of the support levels of the past month or two. So that was good. But 465, this is a $5 spread. So that means the most you're going to make is about 7-8%, whatever 35 bucks over 465 is. That didn't seem to me to be worth doing that. So then I turned and started looking at the condors. Started placing the spreads at 400 bucks. This is at 405, this is 394. So 395, 400 seems like be close. 460 looks like, well, it's better than this one, but this one's kind of risky. And then I started pushing these out. For this first one, notice that we have a maximum gain of 37%. And the delta of the puts, the short put is 13, delta of the short call is 21. So I thought 21's a little dangerous, and it should be. Remember, it's 466, 455. we're at 460. So I pushed that out to 465, 470, and left this as is. That takes our gain, maximum gain, down to 30% and took down that delta of that call. Then I thought, well, selling the 400 when we got 405 and 394, maybe I should pull this down to 390, 395, and also go ahead and move this up. Because after all, 18, maybe this is a bit better. That takes us down to 23%. Delta is 9 and 15. And then I thought, well, what if I go back and push on the put side a little bit? I get this one 27% and 13.15. Now this one is actually a pretty good balanced trade. I was tempted by that, but I was a little worried about this downside because this is a stock that that can have a big move. And when you think about our current market, it's pretty dicey. I mean, it doesn't take much at all to scare people right now. And so you can imagine that maybe the risk is that something is said that pushes this stock lower. So that's why I chose to put on this one. Now, another important point here, notice that when I actually put it on, I only got $81 versus what I was hoping I would get is 93, because when I was pricing this all out, I was just using midpoints and so forth. So that's something that you always are going to have. And sometimes I have started the trade process and realized that the market's just not going to give me a price that I think is reasonable. And so I just back out altogether and take a pass. So always remember, don't just take anything they throw at you. If it doesn't look reasonable, then just take a pass. It's kind of like back when you were dating and that girl turned you down and mom told you, oh, there's other fish in the sea, don't worry about it, just move on. Well, that's the same thing here. There are other trades. So in summary, there's a lot of different ways you can play the earnings announcement, but always remember, these are speculative trades. You don't have any opportunity to adjust them. You don't have time on your side, it's against you. So use the basic money management principles. Price out what your maximum loss is going to be if you just use one contract. And then make sure you can afford that, or if you can afford 3 of them or whatever. When you start pricing out all of like the straddles and so forth, remember, one of the fundamental points here is the market's expecting a certain range. Do you agree or do you disagree? Because it may be that you think it's going to move farther than that. In which case, putting a condor on may not be such a good idea if you think it's likely to blow through that call spread or that put spread. If you're bullish, this diagonal call spread is a good way to play that. But again, remember the criteria I put on that one slide. You have to be able to get that, set it up for a debit that's less than the spread width, and make sure that lower break even makes sense in terms of safety on that price chart for that stock. I mentioned the academic studies earlier. A lot of them have been done, different indices, different stocks, and they all get similar results, namely that the price range that's predicted by the market with that straddle is usually accurate to the degree that about 85% of the time, the actual price of the stock after the announcement is within that range. So when you're setting up a condor, you're betting in effect by putting your spreads outside that range that the price is going to stay within. So with that, I'll entertain any questions, and you've got my contact information here, and also where you can find more information on the Option Hotline website.
Thank you, Duke. Yes, so that was a lot of amazing information, a lot to unpack there. It is time for questions. So for those of you in the audience, if you have questions about what you just heard, what you just saw, really anything related to Duke's presentation, go ahead and type them in the chat box. As a reminder, directly after questions, I am going to be doing a step-by-step walkthrough of how to go onto the website, use the coupon code we displayed, and subscribe to Duke's trading group. So stick around for that. With that said, any questions, go ahead and type them in. I am getting a couple that are coming through, Duke, so I will just fire away if that's okay with you.
Sure.
Okay, great. So the first one is coming from Sanjay asking, when you talked about straddles, were you talking about buying straddles specifically?
Yes. Well, not actually buying it, but pricing it out. In other words, price out what would it cost me to buy this straddle, and that will give you what the price range, the break-even prices for that straddle would be, and that's the information you want. You don't want to actually buy it.
Got it. Okay. Another question from Charles coming in. How would you adjust a diagonal spread?
Generally speaking, you either, well, one of two things happens. The day after, if the price has shot up quite a bit, you might just close it, because typically if that's the case, you could probably close it for the spread width or even better than the spread width. Lots of times that morning immediately after, you can actually get a credit for that diagonal spread that's larger than the $5 of the spread width, and just because the implied volatility is out of whack for the first hour or so. But in any case, if it's somewhere in between, you could possibly buy back that short call and roll it out to the next week. And that will actually give you an opportunity for an increased gain. But more often than not, I just close it the next day.
Okay, understood. Thank you. Another question coming in. You mentioned you don't place spreads for iron condors that are too far out of the money. The question is, isn't it safer the farther out of the money you are?
Yes, it is. The problem is this. Think about it as just a vertical spread. If you were selling a call that was up above your, let's say we've got a stock trading at $100 a share, and you look at a call spread and you say, well, if I sell the 150 and buy the 155, it'd have to move up 50% to get to me. That has to be a very safe trade. Well, when you go to price out that spread, it's probably only a nickel or something like that. In other words, $5 is all you receive. But if you're doing a $5 spread, that's $495 that would be the potential loss. And so you have to look at that and say, maybe I'm not getting enough for taking that much risk. And so I just tend to want to feel like, well, I probably don't want to be that far out. I want to be closer in so I have a reasonable profit to make this worthwhile.
Okay, understood. Thank you. Another question coming in from John. When or how do you decide to use either a calendar, a condor, or a diagonal spread for earnings announcements? And I guess I'll preface that with, I'm assuming you go through those steps in your trading group when you're making these calls. Yeah,
the calendar, I mostly use the calendars when I anticipate a big run up in volatility. If you have stocks, I guess I was going to say like Google, but it's not so much like Google these days. I guess it'd be more like Zoom or DocuSign or these kind of stocks. The stocks that are really hot at a particular point in time, they make good candidates to use a calendar or a double calendar on, because you can put on your spreads a couple weeks ahead of the announcement. And as the volatility climbs, you can typically be profitable and then just close your spreads early. And so that's what I'm looking for those. In the other case, if I'm bullish, if I decided that I think there's a good shot for this thing going higher, I'll use the diagonal call spread. A major piece of that is not only how I can price out that spread, if it seems to be attractive from that standpoint, but also the price moves on the chart that last day or two before the announcement. Because if it seems like everybody's in there buying stock just before this announcement, that kind of makes me think that a lot of people know what's going on and are expecting a good move. And so I pay attention to that. And then the condor is kind of the ultimate, I'm disinterested. I don't really care. I don't know where it's going. I'm just going to make sure I'm far enough out that I'll make money because the move will be less than what I've predicted. And that's kind of how I divvy these out. It's not any more scientific than that.
Okay, a little bit on the same token, Sanjay's asking, and apologies, you may have just kind of covered this, but I want to be sure. Is there a specific strategy you think would be worthwhile when, let's say, if earnings come out before the market opens, to put a strategy on as soon as the market's open to try to catch that volatility wave?
Oh no, that would be very dangerous. I actually don't trade very often in that first hour of trading every morning. Because the first hour is always so choppy. It's a wild time, and the only time I do that, so for some of these diagonals, have been the only time that I've put on spreads in the first half hour of trading, or taken them off actually in this case, because I would put on the diagonal the day before, and then in that first 30 minutes, I can see that I can close it for a very attractive gain, and I just do so. I just get out. And I've had some of those recently where in the first 10, 15 minutes, you could have made 40%, and an hour later, it would have been 25%. And it's so it's a wild time. And trying to start a trade during that first hour, that's a risky place to be playing. It's just dangerous. You don't. In fact, just think about how often we watch the market. The futures are positive. The market opens, it's positive, and within the first hour, it's negative. I mean, it just often swings back and forth in that first hour.
Yeah, understood. Thank you for clarifying. And Sanjay, thank you for asking that question. I think it was important for you to make that clarification. We are pushing up against the end of the question time, so I'm going to call last questions before we move on to general reminders and a walkthrough of how to get involved with Duke's program. Okay, one last question for you, Duke. Are your diagonal spreads all credit spreads?
No, they're all debit spreads.
Okay, could you explain that a little bit?
Sure. I'm buying the long call out in the money and out at least a week, maybe a month even. And then I'm selling an at the money call in the current week, the nearest term option expiration I have. And so that means I'm paying a fair amount for that long call because it's in the money and out has more time. And I'm selling an expensive front month call, but it's going to be a lot less. It may, that front week or front month call is going to be hyped up because of the earnings announcement. So it's going to be expensive, but it only subtracts a portion of that long call cost. So it's always a debit. It's just a matter of how much of a debit. You want it to be less than the spread width.
Understood. Thank you for clarifying that, Duke. All right, everyone, we are going to have to pause with the questions, but a reminder, if you have more questions about Duke's trading and his products, go ahead and put your name and phone number in the chat box, and the rep from Market Education will reach out to you, and you can ask all these detailed questions of them. So please feel free to take advantage of that. I want to thank Duke for putting on the great presentation and taking the time to answer everyone's questions. Again, if you have more questions, put them in the chat box and we'll reach out, or you can reach out to Duke directly. But right now I do want to walk through, as you can see, we're on the Option Hotline website. On the commentator page, I've clicked into Duke's trading group, which he has been talking about this afternoon. You can choose a monthly or an annual subscription. For today's purposes, I'm going to choose annual. I'm going to add this to my cart, and while I'm doing that, I'll demonstrate how you utilize the coupon code that we displayed earlier, and perhaps the enrollment coach from Market Education might want to come back on and just let everyone know the additional information they'll get should they want to put their phone numbers in the chat box and get a personalized phone call. So while I do that, I'm clicking in here to the coupon code gray box and typing in 100FORYOU. That is the coupon for a discount for Duke's Trading Group. I click apply coupon, and the internet does its magic, and there you go, $100 off right there just for being an attendee of today's webinar. So please feel free to go to the website, proceed to checkout, enter the coupon code, and get started with Duke and his trading group this afternoon. Go ahead and put those questions in the chat box. Stephen, if you're there, if you want to say any last remarks, feel free while we wrap up.
Sure, I am here, and I'd like to just reiterate to anyone that's still here, if you'd like to put your name and phone number in the chat box, I'll give you a call personally. And one of the things we're going to talk about is we'd love to invite you to become a member of Dr. Duke's Trading Group service, as Natalie is displaying right now. As a member of his trading group service, you receive trade alert signals, which are exact entry and exit instructions sent to you by email and by text directly from Dr. Duke. And if you didn't know, in 2019, Dr. Duke's trade alert signals for this service were up 214% on 92 trades with a win-loss ratio of 80%. This service is up now 268%, pardon me, 268% year to date in 2020. And I think you'll agree 2020 has been a pretty tough year with the election and with the way COVID-19 has impacted the market. So I would love to speak to any of you personally and privately to answer questions you have about the frequency of trades, the risk versus the reward. I'm here to give a good education to make sure this is something that you understand and is a good fit for you.
Thank you so much, Stephen. I appreciate that. Go ahead and everyone, if you want to take advantage of that, please feel free to type your name and phone number in the chat box. Now I'm just going to do a little recap of the tour we took before the webinar, just to remind everyone if they have general questions or if they forget on how to get in touch with us, please head to the contact page on optionhotline.com. Use webinars@optionhotline.com to email us about webinar questions. Use this phone number and email address for Dr. Duke's specific product questions. You get more information there. And please remember to go ahead and whitelist all of our Option Hotline emails. You can download the contact card to make it easy on yourself so that you be sure to receive our contacts and get information about our free giveaways, webinars, and the like. One final reminder, you will all be receiving an email from webinars@optionhotline.com with today's recording of the webinar, as well as Duke's free gift, and a reminder about those coupon codes. So please feel free to look out for that information and join us at optionhotline.com for the next upcoming webinar. Duke, thank you again. We appreciate it. Everyone who came this afternoon, we appreciate you all taking time out of your days to get some trading education with us. We appreciate it, and we hope to see you back at the next webinar. Right now we have one scheduled for November 11th, so go to our webinars page, sign up for that webinar, and make sure that you are registered. And other than that, I hope everyone has a great rest of their afternoon, and we'll see you back here at the next one. Thanks, everybody. Have a good night.